If you're pulling money out of your business bank account like it's your personal ATM, this video might just save you from a massive tax bill. A lot of business owners assume they can just transfer money to themselves whenever they need it. But how you pay yourself matters. And if you get it wrong, you could end up paying way more tax than you need to. I'm Davie. I'm a chartered accountant and I run regular coaching sessions with my clients to help them avoid tax traps and structure their payments correctly. This deep dive is a recording of one of these training sessions. And by the end of the video, you'll learn all about paying yourself a salary, taking out dividends, and Division 7A loans. The pros and cons of each method, and how to decide which one makes the most sense for you. Let's dive right in. There's usually 3 ways to draw money out, and it usually causes something called Division 7A loans if you do it wrong. In your situation, what type of business are you running?
It's tricky. So the business owns a pharmacy.
Yeah.
Yeah.
Gotcha.
Yeah.
No problems. And then are you an employee of the company?
I am the shareholder. The director.
Yeah, director. But
Yes.
do you take wages?
I do separately on another, so separate to this,
Yes.
separate to my company.
Okay,
Yes.
and then you take
Yeah.
like dividends or
Yes,
yes.
that's right. Yeah.
Perfect.
Yeah.
Yeah. So generally what happens is when you're running a business through a company, there is 3 ways to take money out. And the 3 ways are a loan, the first way, and you're just drawing money out. So like you literally go into the bank account of the business and you transfer money out. So that's one way of doing things. Second way is a dividend. Dividend can be fully franked or unfranked. Okay, and I'll go into more specifics of that later. But the next one is wages. Wages, salaries, directors. Sometimes people say, "Oh, director's fee. Can I pay a director's fee?" They're basically the same thing. Yeah. Okay. So there's pros and cons in all 3. But the wages and salaries, if we dive into it a bit more, the pro is taxes are paid by the company. The con on that is taxes paid per quarter, or month. So you have to kind of take up the wages tax, as you go. And the problem is the ATO is actually trying to make that basically that from the day that you make your payment for your wages, they want to take the taxes and super out straight away. So that's what they're trying to lean against. They're trying to do payday super. That's happening in July next year. And then eventually it's going to be income tax withholding same day as well. Yeah, so they want you to pay and remit the taxes to for the employees to the ATO straight away when you make those pay slips and make the payment to the employees. That's a con, and the reason being is because it affects the cash flow of the business. Yeah. But the great thing about it is you as the director, or if you're the director of the business, or you're a shareholder, if you receive wages, you're not paying for the taxes yourself personally out of your pocket. The company's paying for it for you. Another good thing is you're covered by insurances. If you get wages, generally the company has workers' comp, and if you hurt yourself during work, you can just lodge an insurance claim. So obviously then the con is also you have to pay workers' comp. Yeah. Another con is also you have to pay extra compliance, which is taxes, super, and possibly payroll tax. Okay.
Yeah.
The pro of wages is you get pay slips. So why is that important? Is because when you go for a loan and you go or you want to go for rent, like you're renting a property, they usually ask you for pay slips. Same goes with going for loans. So pay slips show that you actually earning income. And it's actually a bit complicated when you own a company and you don't get pay slips. You get dividends, because then you have to show them your tax returns. But if you just started the business or you haven't lodged your tax returns, you can't really show the tax returns straight away. You have to wait a year to show the tax returns, and that takes a bit of time. So that's why wages is useful to use. Also, paying wages People generally like that because of cash flow reasons. So you get cash flow from the business, you get like wages to yourself, and you can use those wages for personal use. So some people love like having some sort of cash going to them through wages. I generally recommend it as well. I recommend clients to pay themselves some sort of wages. It could be anywhere between 60 grand all the way to $130,000. That's like generally what I expect. Some clients pay more. They pay up to 180, 190, just so they can stay under the tax bracket of 45%. I think it's a 37% tax bracket when you're paying 190. We generally like do that. And that's for the people that are generating a lot of profit in their business, and they have like expenses that they have to pay for, like mortgage, or rent, or school fees or anything like that. Yeah. Obviously, the con to that is extra compliance work. Means they have to pay like the wages on a fortnightly or weekly basis, which is annoying sometimes for business owners.
Yeah.
But when you didn't have wages and you just made all the profits in the company, you would have noticed that your business activity statements would have been small because you're only just paying GST. But when you take up wages, your business activity statements would include the wages tax. So that's why your wages go up. Your taxes go up. And so your BAS goes higher. And that's hard for cash flow sometimes for the business. Great for your personal name. So amazing cash flow for your personal name because you get money in your personal name, but not good for the company. But sometimes it's better to take the money out, especially when the business isn't doing so well. Like if you don't take any wages and you just give up your wages, that means that the business might fold one day and you don't end up ever showing any money. Like you're not entitled to any of the money that's in the business. So you just lost like wages completely. But if you show the wages and you leave the taxes for the company to pay, and say the company folds, at least your wages go to you and you might get a tax refund when you do your tax return. And if the company can't pay its taxes and it ends up folding, you get a slap on your wrist as a director, because you just, ran a business, but it failed. That's okay. The taxes go with the company. So the company can close down, get liquidated, and the taxes go with the company, and it's not under your name. I do see some clients, like they don't, like especially as a sole trader, if they operate through not a company, but through a sole trader, and then they just drew all the profits out of the business, didn't pay the taxes. Unfortunately, the tax follows them because it's lodged under their personal name. By paying wages, the company is obligated to pay the taxes, not you personally. So that's like a huge benefit because the taxes then follow the companies and is the company's responsibility. So if the company goes into cash flow issues, it gets liquidated. Generally, if you do everything right, the ATO can't come after you personally. Obviously, there are some reasons where the ATO can come after you for the company's obligations. But most cases, if you do everything right, the taxes fall under the company and you're protected. Yeah, cool. Does anyone have any questions about wages and salaries?
So when you say the company pays the taxes for you,
Yes.
does that mean it just gets taxed at the company tax rate?
Yeah,
Is
that's
that-
a very
yeah.
good question. The answer is no, that it's not the company tax rate. So in your balance sheet, you'll see that wages payable will come up here. It's not showing here anymore because it's been paid off. But this is like an example of a balance sheet that I have of a client's. Wages payable will show up. Wages payable and wages tax, PAYG tax, withholding, payable will show up here. And it will show up around here. And that amount, that tax rate is depending on the employee's taxes. So if you go to pay calculator and you pay yourself only $45,000 on the annual salary, and you calculate what your weekly taxes is, you'll see that 99 out of 865, and they're only withholding taxes for 99. So if you see that, that's not the same tax rate as a company tax rate. 99 divided by 865 is like 11%. So you're withholding based on what the tax rate is for that individual. I generally encourage clients to pay anywhere between 45K. Oh, well, I said 60, but yeah, 45K all the way to 130K if they don't really need the money in their personal name that much. Okay, they're not big spenders. And why do I say 45 to 130K? Is if you scroll down here and you go to tax rates individuals, we generally like to stay at this tax bracket here.
Yeah, okay.
Why do you think that?
The lower before it ticks over to the next
Yeah.
tax bracket.
But also the company tax rate is 25%, right?
Yeah.
So it's like the similar tax rate as the company. I don't want you paying too much more. I don't want you paying more than the company tax rate because that's ridiculous. But I also don't want you to pay 16 cents. I would love for you to pay 16 cents in a dollar, like 16%, but no one can live on 45K. It's just impossible in Australia, especially. So that's why I pay about the 45 to 130K mark.
So if you have another job, so a company is one thing, but say if I've got a full-time job elsewhere, if I get wages from the company, that adds then onto my
taxable income. Yes.
Taxable income.
And then the result is that you might have to end up paying a higher tax because pay extra taxes at the end of the year because both employers are withholding thinking that you're going to be at 30 cents, but you end up being 45.
Yeah.
Yeah. So that's why in your situation, you might just like ask for, like if you actually work for the company that you own, then you might just ask for just a small amount of wages and the rest as dividends. Yeah, and why is because you want to be covered by insurance if you hurt yourself at the business that you run. Yeah.
Okay.
So this is a profit and loss for a client, and these are all the multiple years. So if you take up wages, you'll see that the wages show up here, and it actually reduces your net profit, and then you pay taxes on your net profit. So if your wages are like 0, then obviously your profit's higher. Okay, so that's how it affects your P&L. I'm just being, I want to show you guys that because the reason why I want to show you that is because that changes when it's a dividend. So if it's a dividend instead of wages, what happens is we don't take up dividends here. So you'll see that there's no dividend payment here at all because dividends actually come out of after tax dollars. So after you show your net profit, we then take it and then pay the tax of income tax of 25%. So we take income tax of 25%. So that's like 25% of that. Let me just bring that over here and just ignore those. Let me clean this up for you guys. Yep. So that's how much taxes you pay. And then you're left over with net profit of this after tax. So that's your net profit after tax. So this is what we show you. And basically, once you've paid this tax, we declare it, like we do it at the same time, but we declare a dividend and we take out we can pay you 350K worth of dividends over to you because the company's paid 25%. And so therefore we can issue a dividend of 350K over to you. How does it affect the P&L? Basically, it doesn't affect the P&L. The dividend doesn't adjust your profit and loss. It actually happens after your taxes are paid. So we show this to the government. We show a profit and loss of this, and then the tax gets taken out, and then a dividend is declared after. So it doesn't get deducted. It's not a tax deduction, dividends. It happens after your taxes have been paid, generally, okay? Remember how I mentioned there's fully franked and unfranked? So fully franked means that the tax has been paid, and that means that if you take a 350K for this year of, I think it's 2024, that means that 350K dividend has a franking credit of 25%, meaning an income tax credit of 25%. So if you took the dividend, the full amount of 350K for that year, that means that in your personal tax return, your personal taxable income, you will show 350 plus the tax credit, the fully franked dividend, franking credit, they call it. It's very similar to like wages tax. You know how when you got a pay slip and you see gross wages, net wages, and tax withholding? So that when you show that to your accountant or you put it in your tax return, you don't pay taxes on the net wages. You pay taxes on on the total gross income that you earned. It's the same thing with dividends. The dividend will get, they call it grossed up, and it will get added together, and it will, you in your taxable income or your personal tax return, you will show $467,000 as income in your tax return. But then you get a credit that you've already paid these taxes and the company paid that for you. So that's how dividends work. Yeah, so dividends are very different from wages. It's not an expense. It comes out of your after-tax dollars, and the credit, there's also credit similar to pay slips and gross wages, but it just comes after the taxes. Okay, why does it do that? It's because the government doesn't want to double tax you. This is one thing they do really well, which is they let the company pay the taxes first, and then once the company pays a dividend out, the tax credit follows the dividend to the individual. So therefore they gross it back up, but then you pay taxes on this. So what happens then? Assume that's all the income you earn, 467. You don't have any wages in your pay slips. So you go back to the pay calculator. This is in your tax return. What would happen is 467,414 is showed as your income. Your tax rate, your total tax should be 190K, but the company's paid 116K in taxes. So 190K is the tax you'll pay. So that's the tax payable. And the net tax leftover pay that you'll need to pay is $73,000. Net tax payable. That makes sense?
Yes.
Yeah. So sometimes it's the opposite, where like you've actually overpaid too much taxes. Yeah. So there's too much credit and you get a refund. Cool. So that's how dividends work. And the good thing about dividends is it's after tax dollars. So it doesn't affect the P&L of the business, which is good. Sometimes you want to show a good profit of the business. You also don't need to deal with super, which is 12%. So if you're the only employee of the company, you don't care too much about super, paying a dividend is a better idea because you don't have to deal with super, which is 12%, and you don't have to deal with workers' comp. Whereas if you were to pay it through your wages, you'll have to deal with that. Downfall of like a dividend is it's not a tax deduction in the business. No tax deduction, so the company shows a higher profit. Okay, that's a good thing or bad thing. Sometimes it's bad because showing a higher profit means more taxes. Sometimes paying a dividend also means that your personal taxes are really high. Dividend equals personal taxes are high. But I'm a big fan of dividends. I like dividends. It's because you don't need to deal with super, don't need to do workers' comp, and then you don't need to do with the most hated tax, which is payroll tax. Okay, don't confuse payroll tax as PAYG withholding or wages tax. Payroll tax is a state tax, and they generally charge you 5% if you pay wages of over $1 million. So if you have like $1 million worth of of wages, they generally charge you like a 5% on top of every dollar over $1 million. It's in New South Wales is 1.2 mil. Victoria, I think it's about 1 mil. So yeah, generally the pro is that you can ignore super, you can ignore payroll tax, you can. However, once you pay the dividend, the individual pays the taxes and has to deal with it. There is a franking credit of 25 to 30%, but the individual has to pay its own taxes after the franking credit is deducted. Cool. So that's dividends. It still helps with your income, and it still shows as income in your personal name. Okay. The last thing is loans. Loans, people love it. People think it's the best thing, and it's because there's no taxes on the loan. So if you actually have like $300,000 of money in the company, this is how it affects the profit and loss. So I'm just going to assume this all stays the same. There's no dividends. I'll delete the dividend part. This is what happens. So if you decide, oh yeah, I've got $467,000, I pay taxes of income tax, so this 25%, and then I'm left with this amount here, net profit of 350. If you decide to take that money out, nothing happens to your profit and loss. Your profit and loss stays exactly the same. So when you take that as a loan, if you minus 350K out as a loan, it doesn't impact your P&L. So we don't make any adjustments to your profit and loss at all. It still looks the same. What does change is something called a balance sheet, where here there's something called director's loan, and your director's loan will go up 350K, and then obviously your cash at bank will reduce. So like you have 300K in your bank account. If you take 150K, say 120K loan, this will drop by 120K, and that will get transferred out to your personal name. And then now the company has a negative director loan, meaning that the company's owed 120K from the owner. So director loans are an amazing way of cash flow, just helping you temporarily of using that money personally. However, you got to be very careful with director loans. Okay, the ATO hates them. All right, the ATO despises them, and so they created something called Division 7A. All right, so they created a full new rule. This is ages ago. I can't remember exactly what year they did it, but they created a rule, and they realized that all these rich people that ran businesses was just drawing money out of the company, paying 25% taxes. They showed a profit of 25%. They know that your tax rate's at 47% in your personal name, but everyone's saying, oh no, I'm not actually paying wages to myself or a dividend. I'm just taking a loan from the company. And so therefore they able to only get taxed at 25%, and it doesn't affect the profit and loss. The profit and loss still looks great. Company still looks like it's profitable. And also the individual doesn't need to show the dividend or the wage in their personal name. It's just a loan. So they argue that this money is going to be paid back eventually, which never did. And then the ATO got very frustrated, so they created something called Division 7A. Division 7A came in, and basically the way it's worded with the ATO is very confusing. So the ATO basically says that if you've taken money out of the company, if you borrowed money out of the company, if you've used it for personal use, if you've put it into a trust, or you were supposed to pay it to your trust but you didn't pay it, or if you had fringe benefits, or any of these situations, they basically say that money that you technically owe the company becomes a unfranked dividend, they call it. And when I remember how I mentioned unfranked dividend, it means that their tax hasn't been paid on it. And so the ATO then goes, if you take, say, $200,000 out, we're going to make you pay taxes in your personal name, and we're going to treat it as if you haven't paid the taxes in the company. So remember how I mentioned, if you made a profit of $200,000 or 300K in the company, and you took a dividend out, you pay the taxes, and the tax of 25% follows through to the individual. The company, if it's branded as a Division 7A unfranked dividend, the ATO says that we're not going to give you the tax of that 25%, even if the company paid for it. We're going to just treat it as 200K income with no taxes, and you're going to pay taxes on that at 47% or whatever your tax bracket is. So you're going to pay 94, and you're also going to pay 25% here. So what ends up happening is you pay 144K divided by 200K, you've paid 70% in taxes. That's the rule that ATO has created. That's what Division 7A is. Yeah, so they basically said that any money you draw out and we don't classify as a proper loan, we're going to treat it as an unfranked dividend. Yeah, that's how Division 7A rules are written up. So it's very confusing. So because when you talk to an accountant or a business advisor, they say, it's a Division 7A loan. Do you have a loan agreement and all that stuff? So like that gets very confusing. Like why, like when you read it in the ATO, why doesn't it make no sense about like a loan agreement and minimum payments? Like that's the part where, so that's why it gets confusing. The way the ATO is written it is saying that if you've taken money out, we're not going to treat it as a loan. We're going to treat it as an unfranked dividend. But what the accountants, business advisors, and what you should be doing is you're basically, when you take the money out, you need to commercialize the loan. You need to treat it in a way where it's an actual commercial loan between the company and yourself. For the ATO to clearly define it as a Division 7A loan. So what they mean by that is the company needs to have clear minimum repayments. And let me see where loans, where does it say it? Sorry, it needs to have minimum repayments, division. So let me just write this down. Minimum repayments. It has to have a loan agreement. So these are the like rules that for it to be complying loan agreement. So complying under Division 7A. So they basically said that you need to follow these conditions for it to be treated as a loan under our perspective. Because if you don't follow these conditions, we're going to double tax you. We're going to tax you in your company, and we're going to tax you in the company in your personal name. So what they've then argued is, all right, there needs to be a benchmark interest. And this one is what we're going to release every single year, and you got to follow these benchmark interests. 8.37%, 8.77. These are the rates that we want you to use. So you need to charge that from the company to yourself. You also need to have a loan agreement in place. You need to have the loan can only be for 25 years if you secure it, or 7 years for other loans. Most of the time it's 7 years. So you can't have it longer than 7 years. So you have to repay it within 7 years. There also has to be minimum yearly repayments, and the repayments has to be like taken into account. Like you have to actually show that the payments are being made. If there's employee loans as well, they want to clearly define what an employee loan is, and if it's a fringe benefits or ignore the employee loans. But the main thing is that they want to know repayments, minimum repayments. They want to see that there's the interest rate charge. They want to see that it's within 7 years. And they want to see a written loan agreement. If you don't follow those rules, that would automatically assess that 200K that you've drawn out of the company as taxable income to your personal name. And this is what happens. The first year that you lodge your tax return, you won't show that income because you think it's a loan. You'll show the income here, you pay 25%, great. In the second year, you might do the same. You might take another 200K out, you won't show that income in your personal name, pay 25%. Maybe the third year, that's when they realize they audit you, and then they'll audit your personal name and the company, and then they'll see that you've taken 200K out each year. Then what they will do is go back to your personal tax returns and assess that 200K and add 200K on top and make you pay the extra taxes. And they do that for the last 2 or 3 years. That's what the rules Division 7A has resulted, and it's impacted a lot of high net wealth people who run businesses, and they just take money out without declaring it as a dividend or wage. And they've been treating it as a loan, but they're not doing it right. So what happens is on a yearly basis, you're supposed to write up a loan agreement. You're supposed to treat up all the interest. Okay, sounds very confusing. That's generally why accountants and also business owners try to avoid doing this, because it's so it's risky, it's scary. But you've got us as your accountant, so we will help you when you take the money out. We'll just help you with making sure that this loan agreement and the loan agreement you create and the interest rate and all that stuff is compliant, and so therefore you don't get double taxed. Does anyone have any questions?
Yeah, why director choose to withdraw the money as opposed to getting the salary or unfranked dividend?
Yeah. So remember, it's not going to be an unfranked dividend. So what happens is it's a loan that can be paid back by the company. So why do you borrow money to buy a house?
Cash flow, right?
Yeah. But you have to pay it back, but you know that you're going to make the money back and pay it back. It's the same thing with loan Division 7A. You don't want to you don't want to treat them. You don't want to generate all that income because you're going to be paying 47% tax on it, right? If you paid it to yourself. So some people rather just take a $200,000 loan from the company, and then lend it to themselves, purchase an asset, and then pay themselves wages for the next few years, and then repay the money back to the company, or take dividends slowly.
And when you pay back to the company, it gets 7 to 8%. Is that right?
Yeah, interest. You charge every single, no, not that like based on the payment, but they charge interest between the company and the individual. So you'll see in the profit and loss of the company. So this is the profit and loss of the company. You'll see interest income in here. So you'll see, assume this other income is interest income. You'll see interest income because it's charging interest on the loan that it's lent to the director or shareholder. Make sense?
Yeah.
Yeah. So you'll see interest. And the great thing is, Patrick, because you say you bought an investment property in your personal name, you can claim the interest as a tax deduction because it's kind of like a loan, like you're borrowing money for from the bank, but instead it's like an 8% return. Why take 8% over like going to a bank? Because sometimes banks might charge you more. Yeah. So banks do charge 6%, but like if you can't get the loan, then you borrow from your company. Yeah. So what, like I've got like I use this method on my property that I purchased, like for my home. All right. Why? Because my first home, it was $1 million. I paid myself a very modest salary in my first few years. I didn't have enough money, but I made all the money in the company. So if you look here, like it was only, what was this? 2018 to 2020. I made $68,000. I made $179,000, and then all up, I made $300K. So that was enough to be able to, like, after paying taxes, I'm left over with this much money, right? This much in the first 3 years, $250K. So I needed to leave some money in the company so it can run. So I left $50,000 and I took the $200K out. But if I took the $200K out and paid it to myself, what would happen? I'll lose like a bit of money for taxes because I had to pay a top-up tax. But then I didn't want to pay the top-up tax. So I bought the property in my personal name, bought it for $1 million. But then after a year, the property actually went up by 1.4 million. Okay, why did it go 1.4? It's because I invested a bit of money to renovate it. But it was a very bad property when I first had it. So it was not livable. So when the banks, like I got it very cheap because no one wanted to buy it because it was a very ugly, it was like a haunted house basically. Renovated the property, got it I got it valued at 1.4 mil. And then I went back to the bank and I actually refinanced and took like 200K out of the equity because the next year it went up in value. Then what did I do? I got that 200K and repaid the director's loan that I had of 200K. So therefore I didn't need to pay the top-up tax. I did pay a bit of interest during the years, like 8%. I get to claim that. Well, in that case I couldn't claim it because it's my home. But yeah, I got to I put the money back into the company. Why did I need the money in the company? It's because of other reasons, but I wanted to grow. So you notice that in 2020, I bought a property. This is actually my P&L, but with a bit of changes. But in 2021, I then invested a crap load of money on wages. Like I hired a whole lot of people. So I need to put the money back into the business.
Yeah, sounds good. Yeah.
Yeah. That's why people do it. Most of the time, people take Division 7, like they take the loan. It's usually because they want to buy a Lamborghini or invest or buy a property or something like that. Something always personal. Yeah.
Okay.
What do you think?
What
Annie?
I was thinking, like,
yeah.
If you withdraw money like 200,000K and you reinvest in stock market, and then you get higher return on investment, but when I compare the interest rate that I need to pay back to the company, which is 7 to 8%.
Yeah.
But I was thinking that it would be almost impossible to beat the market. Like you wouldn't.
Yeah, as in
be
like
able
the
to
interest
get,
rate's
like,
so high.
yeah.
Why would you even like try to claim the interest, right? Yeah. So you need to use leverage to like in a loan it's useful for that strategy I had with property. A lot of people do this and they don't get advice. That's why they do this, but they take the money out and they invest in their personal name. And I see it so many times. They always come to me and they purchased like 3 properties in their personal name or under their wife's name, and they had to draw the money out, and they didn't take up the Division 7A properly, and then I had to like tell them, hey man, you got to fix up your Division 7A, you're gonna have issues, and so they they come up with the loan agreement. Okay, generally the loan agreement needs to be done like earlier, but this is an example of a loan agreement, right? So it's like full decked out like terms and conditions, agreement, like definitions. It talks about like what the borrower can do and what can't. This talks about the the repayment schedules, interest amount, and the term, and then it has to be signed by both parties, right? So that's what a loan agreement is in place, and they have to do that. But the thing is, they buy everything in their personal name, and the worst part about it is if they don't, they could just take a dividend. Technically, they can avoid all of this stuff and just take a dividend, like what I said, a dividend, and it will clear that. It will clear the Div 7A because you don't have to repay the money back. But the problem is the individual then would, if I took that 200K and I was paying myself a $100,000 wage, and I took another 200K, what would happen? I would have that times 25%. My total income for that year, for 2020, would have been 350K. So this is what happens in real life. You put 350K here. I've taken the 200K, bought a property, spent all the money, and then I'm left with a tax bill a few months later of 135,000. And then the accountant then goes, great, like good job of buying the property. But you lodge your tax return 6 months later. Like you don't lodge it straight away. You wait until after 30 June. And the following year, which is 15th of May, is when you can lodge your tax return. But you're left with this big tax bill in your personal name, and no one wants to pay it. People are like, well, I've already spent the 200K, and I already spent my wages. Like I don't have any more money. I'm paying a mortgage right now, and I'm stuck with this tax bill of 135K. So there's 2 options now. They take a payment plan with the ATO, or they convert this. Well, they should have done it already, but they treat it as a loan and Div 7A loan. Yeah. And that's where, like, it's actually like, it's a reactive move. Div 7A is actually a reactive move. They didn't get proper advice, and then they had to do Division 7A. That's what happens. The accountants are like, hey, you got this big tax bill, and no one wants to treat it as a dividend. So they convert it to a Div 7A loan. It's actually, if you see Div 7A loans in your business or your company, most likely you didn't get proper advice and you're now reacting towards trying to avoid the taxes. Yeah, that's what generally happens. You don't want to pay the 135K, so you treat it as a loan, and that gets deleted off your system, and then you don't pay the 135K. Make sense, guys? Okay, now, if you got proper advice, this is how to avoid it. So if you get proper advice, this is what you do. In my case, you couldn't have done anything because my home is for my personal use, so I had to buy in my personal name. But I'm using your example as a option. So instead of, you said you wanted to invest and buy shares. So you don't need to invest it and buy shares in your personal name. You could have like lent the money or paid the dividends to a trust, and the trust gives it to the bucket company, and then you buy your shares here. There's no Div 7A issues if you have like lent the money, you pay the dividend to the trust pays it to the bucket company, because the tax rates for the company and the bucket company are quite similar taxes. So you're not going to pay a top-up tax that much, whereas compared to here, you're paying 135K if you paid it to my personal name. Why? Because the tax rates in the individual is 47%. It's like 22% more. So that's why you're paying such a high tax in your personal name. But if you invested and did your investment in a company to company, they generally have the similar tax rate, if not just up by 5%. That's why if you get the right advice and you're buying shares or buying business, buying a investment property, sometimes it's actually better to like transfer the money into a bucket company, lend it from the company to here, or pay a dividend from the company to the trust, and the trust distributes it to a bucket company, and then you pay the taxes of 30%, but then it's a lower tax bracket and you don't have Division 7A problems. Yeah. So if you got the proper advice, you would actually probably invest your profits in the bucket company. Some people don't even use a bucket company and they just invest in a trading company. You can do that too. You can buy shares in your trading company. Then you don't have Div 7A issues. Yeah. So it just really depends on what you're using the money for and getting the right advice. So a lot of people just don't get the right advice.
So if you put money into that bucket company, you loan, you still have to do or tick all those boxes, like have a loan agreement, pay back the loan 8%.
No, you don't. That's a very good question. No, you don't. And why do you think that ATO doesn't care about having a loan agreement?
I don't know.
Because the tax rates are the same. They only care about this is because you're escaping that 47% tax.
Right. Okay.
But the company to company does have the same tax rates. You've paid the taxes here. They're gonna there's no point chasing you for another if you've sent the money over to a company because they both have the same tax rate.
So if
okay. That's why Division 7A is such a big deal. It's because people don't get the right advice and they send the money over to the individual name and then draw it all out and buy in their personal name. I had this $100 million client. He booked a meeting with me. He's not my I'm not his business personal accountant, but he books meetings with me for consultation all the time. And he said, Davie, I need about $40,000 of dividends every month from my business. And I'm like, and then he's like, I've got huge Div 7A issues, so I need to take a dividend every month of $40,000. I was like, man, that sounds a bit ridiculous. Like $40,000. What do you need $40,000 for? That's like $500K on top of his wages. And he's like, because I've got mortgages, Davie. And I'm like, okay, I get that you got mortgages, but why did you buy all your investment assets in your personal name? And he's like, couldn't I bought it? He also bought something in his trust, but he bought most of his investment assets in his personal name. And I said, that's why you have to take such a big amount of money from your company, because you just didn't get the proper advice and you're taking everything out and buying in your personal name. So therefore you have to draw that money out and pay the highest tax rate ever. But if you got the right advice, you could just invest using a bucket company or a trading company. Yeah. And I think I wondered to myself why this is the case. And I've started to come to a point where a lot of rich people back in the day have found a solution towards taxing the poor and getting more rich. And how they did that is they created this they started lowering the tax rates of the company. And they back in the day, companies were the only the people that own companies were all rich people. The people that ran businesses were always rich. And so what they did was and this is just my opinion, I don't know if this is true, but I think what they did was they used politics to lobby and get the tax rates lower. So companies' tax rates went down to 25-30%, whereas personal tax rates stayed at 47%, which is 50%. So the people that worked for companies and got paid a lot, like 100K, 200K, would get taxed at 47%. But if you made $1 million or $2 million, you'll get taxed at 25%. Isn't that ridiculous? You'll get nearly half a tax rate compared to a person that makes 200K. And so they did that, I think, because they wanted to make sure that they kept all the profits outside of their personal name and in these bucket companies and trading companies that they can just draw profits on when they need it. And it's never in their name. So, they always look like they're always paying less tax than everyone else. Pretty cool, eh?
Yes.
Yeah. Is it confusing, guys? But does it make sense?
No, I agree with you, actually.
Yeah. It's the more I studied it, I just went, man, these rich people, they're so smart. A lot of accountants say this. They say, if you ever take the money out, you're still going to pay the 47%. If you take the dividends out from the company, the bucket company, say you invested all your money in the bucket company, you made $2 million. And I can't stand this when people say this. But yeah, they say, well, if I take the $2 million out and take it out in my personal name, I'm still going to pay 47%. Do you guys agree? You probably do. Yeah. Once you take the dividend out, you're still going to pay 47% because $2 million in your personal name, 47% tax bracket. Okay. I say, I don't care. Like, that's just, if you think that way, then you don't know how to run a business because it's and you don't know how to invest. Because if you have a lower tax rate for the first 10 years, so say, and I'll use the trading company as an example. So say you made $2 million in 1 year for the trading company and you got taxed 25%. You're left with what? 1.5 mil. But if you took the money out in $2 million and put it in your personal name, what happens? You lose 50%, close to 50% of your money. So that means that you're left with $1 million. So that 2 mil, say this is a company investing and this is an individual. So if you took the money out into your personal name, it's very different. You would lose 47%. I should round it up to 50%, but yeah, 40%. So you're like the money that you lose if you were just to take the money out and pay the 47% is nearly 500K. Whereas if you left that money here and then you kept compoundly investing it, and let's just say you got a return of say 8%, and then you invested it 8%. If you keep doing that and then you keep investing it, and I'm saying like not putting more money in it, just invest that $2 million initially. Look at the difference in 1, 2, 3, 4, 5, 6, 7, 8 years. Look at the big difference of how much you'll be left with if you had a lower tax rate at the very start versus what if you just paid the 47% of taking the money out. You will be left with 700K more than the person that took the money out personally. So that's what I mean, that the rich get taxed more and the poor get taxed more, whereas the rich are smarter with their money because they have a lower tax rate at the very start. And I don't care if you take the taxes now. Like if you take the money out now and pay the 47%, it's not 47 because you already paid taxes of 25% on it. You'll be paying like another 20% on. You pay the 20%, it's still lower. Like you still be left with a lot more money. Yeah. So that rule where people say, you're still going to be paying 47% even if you if you take the money out later. I don't like that's okay. I'm okay with that because I'm having a lower tax rate at the very start.
Mm-hmm.
Yeah. So just leave the money there, let it compound. And the amazing thing is, if you retire at like 60 or maybe even earlier, 40, 45, and you have no more income in your personal name, no wages, no nothing, then you could just slowly pay yourself, instead of like the $1 million, pay yourself 100K each, husband and wife or partner, two partners. Okay. If you pay yourself 100K, you're paying $23,000 in taxes roughly. That is 23%. You've already paid 25 or 30% in your company. So therefore you don't actually need to pay a top-up tax. So you just slowly take the money out when you retire. And that would also solve that problem that people say, you would have the 47% tax if you take it out later. But if you don't need to take the whole 2 mil, you just take it out slowly and then use it slowly. Yep.
So to achieve that top line where you say leave the money in there and let it compound.
Yes.
You're investing it under your company name.
Yeah, that's exactly. Company. Yeah. So you buy shares, you buy property, you let it rent, like you receive rental income, you receive dividends, or you sell it for profit and you reinvest it in somewhere else. That's where, and you can do that not just in the bucket company, you can do that in your business as well. Yeah. Just be careful. Don't get sued and lose everything.
Yeah. Do you have to pay tax on your extra like 8% earnings?
Sorry. Yeah, you do. Yes, you do. You pay taxes, but the great thing is you don't pay the 47% in your personal name. You pay 25 and 30%. Yeah. So I just find it ridiculous when accountants say it's better to you might as well just take the money out and pay the 47%. Because then when you start off, you're already down. The worst part about it is we can use the property that I purchased. If I took the money out and I took the 200K out to pay a deposit, and I paid a dividend to myself, I would have lost 47% of that. So that 200K, like 47, I should have been able to calculate that myself, but yeah, 94K, I would have lost like close to 100K. So really, I would have had only a deposit for 100K to be able to buy that property. I wouldn't be able to buy a $1 million property. I would only be able to buy a 500K property. And that property wouldn't have went up 1.4 mil. It wouldn't have went up 400K. Probably maximum would have went up 100, 200K. So I wouldn't have been able to make more money. So if you're stuck with more money at the start and you pay the least amount of taxes in the short run, in the long run, you'll make actually a lot more compounding. Yeah. Cool. That's it.
Yeah.
Thanks very much and enjoy your evening, and thanks for joining.
Thank
you. Thanks so much.
Bye-bye.